Good afternoon, everyone. David Grau Jr., President of Succession Resource Group here, welcoming you to our session today, as you can hopefully see on screen, titled How to Get PE Value with or Without PE. Obviously, getting PE value from PE is much easier, but we want to certainly unpack what's happening out there right now, private equity backed aggregators, but also how those values, terms, deals in general compare to internal succession or external. Basically, by the time we're done here today, if we've been able to plant the seed, get you a little bit better educated on your options, because the world of M&A, I'm not going to say it was ever simple, but by comparison, I look back 10 years compared to where we are today, and it is exponentially more complicated. And so we want to try to make sure that, especially if you are contemplating selling, and we might even redefine what a seller is a bit today together as a team. If you're contemplating selling in the next, I don't know, 12 months, 5, 10 years, your options are what you want them to be, right? If you call us and say, I want to be done in 12 months, we can help you. If you say, I want to be done in 12 years, we can also help you, and you'll have more and different options. So there is no wrong answer necessarily, unless it's not congruent with the outcome that you're driving towards. Quick intro. In terms of SRG, we're a consulting firm. We're headquartered in Portland, Oregon. We focus and specialize on mergers and acquisitions, succession planning, valuations, or independent financial advisors. That's it. But to be fair, there's still a lot of room between those field goal posts. So you'll see things on screen here that I'll point out that you might look at and think, well, that's interesting. He said mergers and acquisitions and succession, but he has listed here employment agreements or compensation plan design. Well, we do those other elements because they're sort of tangentially related to the work that we do around succession planning. I think of the work that Parker and his team does here on our transaction advisory, where they do internal succession planning. For the longest time, folks would show up and they'd have a great team, great business, but the compensation, they would sort of own it. And they didn't love it. It made the succession planning work more difficult because of how that it was constructed. And it's kind of an old legacy model. So we've been doing a lot more compensation research for folks. We have a compensation report that we generate annually for a lot of our clients, as well as just developing compensation models for true teams, ensembles. And that's not easy. It's certainly not fun, but it's something that we do a lot of. The other one is things like entity structuring and maintenance, right? Well, why would it do that to law firms? The problem is the law firms, they're great at drafting what you know to ask for. The reason why we do things like entity related work is because it directly impacts your ability to get the right deal from private equity, a private equity backed aggregator, to really optimize internal succession, to get a PE like value from your internal team. You need the right entity structure, and you need the right entity and governance documents. We tell folks we know a lot about a little. You are our target clients. You are the only folks that we serve. And really, if it impacts the value of your enterprise, your team, then that's what we do. Why is this conversation happening now, right? It's kind of funny because if you go back and if you aggregated all the trade publications and the articles around private equity, I mean, just as a genre, right? Not as an investment strategy for your clients, but specifically as an investment vehicle, succession tool for you as owners, founders, you think even 4 or 5 years ago, you'd be hard pressed to find more than one or two articles the whole year that talked about either private equity making a direct investment in a firm or a private equity backed aggregator then going downstream and making acquisitions. It happened, but it wasn't the norm. And it was reserved. Certainly, private equity direct investment was very large shop, billions of AUM before that was even on the table. And not because of the AUM, but because of the internal factors of developing a team and a firm that's no longer sort of owner operated. That just takes some size and scale. And so you go back a couple of years ago, it was only the biggest firms taking direct private equity investment. And it was really still only the industry's biggest firms that the private equity backed aggregators were then seriously looking to acquire because, again, they did not want to buy your job. They want you to buy your firm or make an investment and then go do the next deal. You keep running and operating it. So that again goes back to needing some size and scale. It was a pretty rare occurrence. Now you start, do a quick Google search. I realize I probably just dated myself. Do a Claude or ChatGPT search, a query around private equity investments and the activity in it. And in just the last year or two, I mean, it's an astounding amount of the deals. You can see, I put it on the screen for you here. I was so astounded. And we're seeing this, right? I mean, if you go back to transaction data, you'll see here on the far right, it's 80% figure. You're looking at 80% of deals in 2025 involved a private equity backed aggregator, right? And that's the source on this one's Fidelity, but we're seeing it if you look at publications from DeVoe, Echelon, Advisor Growth Strategies, any of these other sort of private equity, not private equity firms, but firms that deal a lot with private equity and have, some larger RIA clients. We're all seeing it. The rub is though, and I'll throw the substat up here for you or anecdote, that's measured by assets under management. If you go look at the number of deals done, I mean, I'm rounding up that it represents maybe 5% of the total transaction volume. And if I told you that, you'd think, oh, well, that's much to do about nothing. It is and it isn't, right? So they are still doing big deals. I mean, for every one of these private equity investments, or even the private equity aggregators in their acquisitions, they're moving downstream. But most of the firms they're buying on the smaller side still have hundreds of millions of AUM. It might not be at a billion yet, but they're getting close. And many of them still have a billion, 2 billion, or more. So if you count it by AUM, yes, they're a huge slice of the market. And it's a fair way. I know why they represent it in this way. 80% of deals in 2025 were involved private equity. That sounds like basically every deal had private equity involved. And if you actually sat and went to a conference, talked to advisors that had done a deal recently, you'd go around and you'd keep talking to people, you'd keep talking to people, you'd be hard pressed to find somebody who actually did a deal with private equity. Because again, the vast majority of advisors, RIAs, have 100 million, 500 million, maybe a billion, but the vast majority are under a billion in AUM. And those deals are bought and sold regularly. You can see here the number of transactions that are reported. You've got stuff from like the public available sources, which is what like a DeVoe, Echelon, Fidelity is reporting on, with the RIA and the successor filings. But I mean, we had 171 transactions last year that we facilitated. And I mean, almost none of those were acquired by private equity or private equity backed aggregators. Some of them for sure, but not a lot of them. So it's just worth considering, but it's enough to get our attention, right? You think of the amount of advisors that are going to be retiring, the multiples that we're seeing and talking about now. It's tough as a founder owner to not consider it. But what I want to try to do today is make sure you know there are other paths. Private equity and private equity backed aggregators can be a great tool and resource depending on your timeline and your goals. So I do want to start there. But internal succession is what the overwhelming majority of advisors tell us that they want. And it's not just us. If you go back to some of the Cerulli studies over the years, this isn't like an interesting anecdote. It's been pretty consistent over multiple years. Most owners want to sell to their team, dot, dot, dot. But they also want the private equity back number that they got in an offer via email a month ago, whenever it was. We can't have both, or can we? If you do it right, you might be able to get close. So that's what I want to spend time on today is understanding all of your options, not because we have a pony in this race. Frankly, we would love to just represent you and take you out to market and make sure if you've got one or two offers in hand, let's get a few more and let's make sure we improve these offers because the first offer is literally never the best offer. And when you're dealing with private equity and private equity backed aggregators, these are some of the best buyers in the industry. And when I say best, I mean they know what they're doing. They can spin a good yarn. And not in a bad way, right? But they know how to highlight the things that should be highlighted. And they know how to downplay the things that shouldn't be. So private equity is not one that you want to go it alone on. But internal succession can work, peer-to-peer deals could work. And I want to make sure we can evaluate those collectively equally. So your option with private equity, just to set the stage. I know